Thank you, everyone, and welcome to our discussion of COVID-19's impact on managing wealth. I'm very excited to moderate this discussion with two brilliant thought leaders in wealth management and the economy. Larry, you've written a bit on why there may be a disconnect between the economy and the stock market. The question that I so often hear right now is, why is it that we're at 15% plus unemployment? It looks like many famous companies have declared bankrupt or are near bankruptcy. How can it be that the stock market is still in reasonably good shape?
So the first thing that people have to understand is the stock market and the economy are two very different things. The economy is what's happening now, and the stock market reflects what investors think will happen in the future. In this case, let me give a great example of that. You're sitting on March 8th, 2009, and you know with certainty the economy is still going to be in a recession through the next quarter with the GNP falling. And the unemployment rate will continue to spike up and rise, peaking at 10%. And a year later, it would still be almost at that level. And if you knew that, a lot of people would say, boy, the stock market is crazy. It's ignoring all this bad news and more coming. And the stock market went up 55% between March 9th and the end of the year and proceeded to go up another 15% going forward. The second thing I would point out is you have to think about what types of recessions we have had. And we've had three different ones in the past. One, I would say, are driven by the Federal Reserve. In a cyclical recession, we get a booming economy, we use up capacity, wages start to go up, the Fed tightens to fight inflation. Those kinds of recessions typically last for a while. The stock market will tend to recover in terms of full earnings, getting back to the pre-peak level of about 3+ years or so. You can have deeper structural ones like we had in 08, 09. They tend to take longer, maybe 4 to even 5 years. And that's about what it took to get out of the 08 crisis. We peaked in earnings at 06. By 11, we passed it. And then you get event-driven ones, which have actually caused the earnings to drop less and to be much shorter, on average, actually about a year, maybe a bit longer. This is probably somewhere between an event like COVID, and it's going to cause big structural damage to things like state municipal governments whose budgets have been hammered on both sides. Lots of small businesses will go under, they can't survive. So I think the market will, you have to think longer. We don't know. A vaccine will determine, or a cure, how long the recession is. So let me just say one last point. If you think the economy will begin to really fully recover when we get a vaccine, and maybe that's a year from now, well, if you think you got a PE of 20 in the next 20 years, 1 year is only 1/20th of the earnings. The other 95% of the value is in all the other years. And the market could think that earnings are going to recover more quickly. That's not my personal view. We could talk a bit about why I think this is more likely to be a U-shaped recovery. Some possibility it'll be V-shaped. Some it'll be L-shaped, and we could talk about those things. But I think because of the systemic damage, particularly state and local governments, which are about 12% of employment, and a lot of people estimate as much as 25% of small businesses could fail and never recover, and that capital gets wiped out. That's going to act as a drag. There are a couple other comments we could dig a little deeper in, but that's some quick things. The economy and the market are very different. Economy is looking forward and anticipating that all this action taken by the governments to stimulate the economy, Federal Reserve pulling out the biggest bazookas ever, much bigger, broader lending programs. And so the market is looking ahead of that. Whether it's too high or not, we'll see only after the fact.
Lawrence, I imagine that you're a little bit more on the pessimistic side.
Well, being an economist, I'm kind of professionally obligated to be dismal. And this is like, what we're seeing here is projected decline in GDP of 40% in the second quarter. The 2008 Great Recession had a decline of 4% in GDP. So we're talking about, in 3 months, output dropping 40%. Now probably will come back, but will come back, maybe it's a 10% year over year decline for the rest of the year, but that's still dramatically worse than the Great Recession. In the Great Recession, the stock market dropped 53% from 2008 through middle or so of 2009. In the Great Depression, we're seeing numbers now that are kind of worse than the Great Depression. A 40% output drop, if it were sustained. Now, again, it probably won't be sustained, but output fell over 3 years in the Great Depression. The peak decline was 26%. We're having a 40% drop in 3 months. And so maybe over the course of the year, it's going to be 15%. So it's not quite as bad as 1933, but it's as bad as it was in 30 and 31 and 32. And what happened then was the stock market dropped dramatically in 29. Then it comes back in 30, and then it goes down in 31 and 32. By 33, it's 86% below where it started in 29. So we have to kind of look at how this thing is going to develop. People will get, what I see is the market is rising on news that turns out to be rather specious about new vaccines, new scientific breakthroughs, which then turn out to not necessarily hold water and are going to take a long time if they do hold water. So what I see is, big sectors. We're talking about education, potentially not reopening. We're talking about, as Larry indicated, state and local government firing large fractions of people, their employment. We're talking about the travel industry being depressed for the long term, restaurant industry, tourist industry. These are major sectors of the economy that are just not going to recover. I don't see any possibility of them recovering because they require confidence. And we don't have, we could generate that confidence by effectively testing everybody once a week in an efficient group batch method where you test a whole lot of people's swabs at the same time so you can economize on tests. I've got a paper at Kotlikoff.net about that. So we could actually test everybody in effect every week and give them a green bracelet and make sure that everybody in a restaurant would see that everybody else has a green bracelet. It's safe to eat. You're not going to get infected. But until we do that, which this president doesn't seem to want to do, nobody's going to, so many people that I talk to, I say, well, when we open up again, are you going to be willing to go to the mall? Are you going to be willing to go to the restaurant? Will you change your way? Will you buy groceries directly rather than getting them ordered? No. That's the reaction. So I don't, just looking at history. And the other thing is once people are unemployed, we have 40 million people unemployed right now. Once people are unemployed and the companies go under, it's very hard to re-coordinate this economy, because if I'm an employer, I say, I'm not going to rehire until I see the rest of the economy's doing well. And then the other people who are potentially hiring my customers say the same thing. So I don't hire their customers and they don't hire my customers, and we just sit here. And that's really the coordination failure that made the Great Depression so long. We didn't get out of that until we actually had somebody who could buy our products, which is the government, the military, and which I think is the explanation for why the Great Recession took so long to recover from.
Let's talk a little bit about the Federal Reserve and the actions that they've taken. I think for the average financial advisor, they don't have a very clear idea of what the Fed has done and the impact that that has had on the markets. Um, what is the Fed trying to do, and how is it impacting the price of financial assets?
Well,
I guess I'll go first.
sorry,
And
sure.
so the number one, I think the Federal Reserve learned its lessons both from the Great Depression and the Great Financial Crisis. Rightly, I think it deserves great marks this time around. It acted much more quickly. Instead of taking months to lower rates, it acted immediately and very quickly, massive amounts. And instead of pumping in $1 trillion or so in liquidity, the total estimate of all the backstops is now like 8 trillion. And the economy is only about 25% larger. On top of that, they've broadened their target to include things they have never bought before, including corporate bonds and high yield bonds and municipal bonds to provide make sure the markets at least have the liquidity. And of course, what they're also trying to accomplish by driving rates to zero is to try to get people to take more risk, which I think that's the real crime here. I think the Fed should have been raising rates well before it did, because it penalized all of the savers. The economy was growing. And what happened is a lot of people, because of, call it zero or very low rates, were talked into buying things like MLPs and REITs and dividend paying stocks. And then when this market hits, those quote safe alternatives turn out not to be safe. So a good lesson, if you didn't learn it the first time around, the bond portion of your portfolio, in my view, should only be served for the sole purpose of dampening the risk of the overall portfolio to an acceptable level. If you want to take risk in other riskier assets, they should come from the equity portion of your portfolio, not from the bond side. So the Fed knows it could get a wealth effect by driving, yields down. People feel better, the markets are strong, and then maybe people also spend from there. So you're getting a combination of lower rates driving that effect. One other comment I would make is related to what Lawrence was mentioning. Lower interest rates is not getting me to go on a cruise, travel, eat in a restaurant, not until we get that vaccine. So it only works so far. It will not have the same effect as it did in the past. This is really why fiscal policy needs to take a major role here. I'm glad to see they took action quick, didn't wait as long. Unfortunately, governments, in my view, almost always screw up and do really dumb things. Like now we're paying people more to stay at home than to go to work, which is incredibly dumb, destructive of the future growth of the economy. People will not want to go back to work. I have friends who can't get people back to work because they're being paid more to stay home. I can't imagine what politician in their right mind would think about doing that when we're now going to be faced with a major problem that we didn't have before. In 2008, we could spend 5–10% of our GNP without blowing up or creating massive problems for the future. Of course, our debt to GDP ratio was not unreasonable. We're now pushing 100%. We'll blow through that probably by the end of the year, and nothing is in sight to change that trajectory. So we could really have problems. And then that only brings to the point that Lawrence wrote that brilliant book, The Coming Generational Storm. We're not even talking about the Social Security deficits and Medicare problems. So that's going to be a real problem that concerns me and creates the risk of even a L-shaped recovery to make us look like Japan if we don't get those things addressed. It's at least a risk. I'm not predicting it by any means, but it definitely should be considered as one of the possible outcomes we ought to be thinking about. So I'll turn it over to Lawrence here.
Yeah, I agree 100% with everything you've said, Larry. Even on the stock market, I can't say, I think you probably have a better handle on it than I do because, I mean, it's doing what what's happening in the actual market. It corresponds to things you're saying. But I'm just worried about where it's going to be next month and 6 months from now. We've seen it go down and up and then way down. So on the Fed's behavior here and the federal government's behavior in general, I mean, I agree. We've got a lot of crazy policies paying people to be unemployed in the context that we're at. It's just insane, bizarre, but, and also not testing people systematically or tracing them systematically or enforcing distancing and mask wearing. This is a prescription for disaster in terms of the economy, let alone people's lives. But the Fed has printed so far, from what I can tell, about 50% more base money in the past year, in just the last few months. So year over year, our base money supply is up about 50%. Our M2 money supply is probably up around 30%. Don't quote me exactly on these numbers because I may be off 10 percentage points, or I haven't checked in a week or so. So we have the basis for if the velocity of money, the speed at which people were using money in transactions went back to where it was in 2007, and the money multiplier, the degree to which banks were lending out money to companies, went back to where it was, we would have a price level that's about probably 5 times higher than it is today. So we already, we have the basis for hyperinflation built into the economy right now, given what the Fed's been up to. And now it could be that for quite a while, the lack of demand is going to kind of exceed the lack of supply in keeping prices low. And we could even have deflation, but we could also ratchet from deflation right into inflation if this continues for quite a while. So I would be concerned about stagflation arising at some point. It's just, the government doesn't have cans of Campbell's soup to bail out the economy with. They can't give people, real physical things. All it has is pieces of paper. The orange piece of paper, government treasuries, the green is the cash. And what we're trying to do is take a real problem and paper it over, basically. Now, it's helping spread the pain, which is important. But ultimately, we need to get the economy back to work and get people confident. So it's going to take real policy, real changes, not fiscal policy, not cutting people's taxes, because again, that's just more playing around with money. You need to have, well, as I suggested, a testing protocol that tests everybody every week by the National Guard, and have people have green bands that go into restaurants and go to malls, and then you get the economy back to where it was, and you basically capture and kill the infection, the plague. You beat the plague. Right now, we're letting the plague beat us. So we have a commander-in-chief who doesn't want to take command. That's our problem.
So Larry, there's been a record issuance of corporate debt over the last couple of months. So a lot of companies are issuing debt in the hope that they'll be able to pay it off. And of course, they're going to face a liquidity crunch mid-year. And if the economy doesn't turn around, then what are we going to see towards the end of 2020? Do you see that large increase in corporate debt as being a big risk, even to equity holders?
Well, first of all, corporations, many of whom will be able to get through this without too much of a problem. Just think Apple or Amazon or Walmart, if they're going out and borrowing, they're probably making record profits, and they're borrowing long-term debt at the lowest interest rates we have ever seen. So why wouldn't you go out and take that long-term debt? And I think most people believe while this is, as Lawrence pointed out, going to be a horrific second quarter, most of the economists that I talk to think the third quarter will actually be positive. Of course, it'll be up from a very low level. So the next, I would say, 6 quarters are likely to be up 5 to 10% each. So the likelihood, if we can get back things normal, it would take the economy at least 2 years, maybe 3 to get the GNP back. It could even be longer for reasons I mentioned, particularly state municipals are going to be under horrific problems. That's what I would worry more about, is the debt of state and local governments. I don't see how Illinois they have to default. It will only be whether they default on their pensions or they default on their debt, but they will default. And you could probably list 5, 6, 7 other states who aren't probably too far behind them. So I think you're clearly going to see some defaults in the corporate sector as well. And that's where lots of people come in. Distressed private equity comes in, buys up these companies often cheap. There'll be a lot of good opportunities then for businesses that survive. Just think, to make something up, a cruise line ship goes out of business, in 2 or 3 years. So we'll have a vaccine likely, and people will go back to travel, and you would have bought those things up cheap. So that industry hasn't been hurt. Where I worry is the damage really to the small businesses, the restaurant, the local hair stores, jewelry stores, whatever you want to think of. They may be generations of capital built up and saved, and now they're wiped out. And personally, I think that we are, in some cases, making just horrific judgments by governors in their states. Just think, to me, as a good example, the insanity of this. So maybe the safest workplace in the country, I was told, is to work in an auto body paint shop. Why? Because you're wearing like a hazmat suit and you got everything protecting you. Why is that not allowed to be open? Right? There's nobody, you can't breathe there, there's nothing there. Or the local jeweler who I visit, one person shop, they don't let more than one person in at a time. And you could say, if you don't wear a mask, I'm not letting you in. But we're forcing all of these to shut down rather than let's take an approach to let, what makes common sense, look at each case, deal with each other. So that, I think, if we use much more common sense and target how we shut down. So we know, I think, something like 80 to 85% of deaths are the elderly, and it's not even people like me in their 60s or early 70s, it's even older in nursing homes. This death rate, we now know, at least it looks like for the average healthy American, is actually about the same or maybe less than the common flu. It's just much more infectious. But the death rate is not that low. And so I think you could actually take more risks, but people should be social distancing. Wearing masks should be requirements, but we don't need to lock down the country in the way it's been done. I think we're doing far more damage in other areas that people aren't considering, like counting the deaths that'll happen because people aren't getting mammograms or cancer screens. I haven't been able to see my dermatologist for my annual checkup. People can't go to dentists, and all kinds of surgeries that should be happening that are, and then you get all of the risks from the, the stress of this situation, the suicide rates. So I think my own view is that we should be opening up much faster, but also forcing better safety measures. And then, of course, you need, as Lawrence pointed out, you need to have better testing so you can allow people to go back to work. But you have to isolate the elderly. So just as an example, I'd open up the schools, but I wouldn't allow teachers maybe over age 60 to be in a classroom, but you could allow others to go back. safely. And then you have to isolate people like me.
So Lawrence, what do you think? There's been a big increase, not just in government debt, but also in corporate debt. Are there going to be any consequences for that?
Yeah, I mean, the debt before this whole thing happened, I think the corporate sector debt was about half of GDP. I think that was, a very high figure compared to from an historic perspective. So we have the Fed buying up all this different kind of these different IOUs, including, as Larry said, junk bonds. And what if these companies do go under, and it may just be a cascading process where certain clearly affected industries go like retail stores start going under, and restaurant chains, and then that impacts yet other companies that have borrowed, who have connections to these companies that go down. So this interconnection of obligations could lead to a meltdown. The Fed keeps buying this paper, and then what happens if these companies still fail? Then the Fed's left with basically useless, worthless paper. So, so some people view what the Fed's doing as just like an asset swap. It's just borrowing, just taking like lending money, and it's on good collateral, but it's not really good collateral. So if we really have the bad side the downside happening, the Fed is going to be sitting there having printed a lot of money, and the Treasury is going to issue a lot of orange pieces of paper, which are not going to be redeemable in terms of anything. So we're going to. That's where I worry about inflation, and I also worry about the official debt to GDP ratio going up to about 110%, as the CBO projects. At some point, people are going to start wondering whether we look like Italy, and whether we should actually be buying treasury bonds that are yielding 1.3% for 30 years, when the inflation rate is projected to be 1.3% too, or even higher. Maybe they'll decide, hey, I don't want to get into this. I'm just going to buy a house with my money because I know I can sit in it, and it's a for sure return, just the the shelter of the house. So at some point, the interest rates may start going up, the long rates, and that again turns velocity higher, and that makes money basically a hot potato. And that means that faster money is like more money, and that's the scenario in which you have both low output and high inflation. And we kind of saw that in the 70s, stagflation. I'm old enough to remember that. So that's, yeah, the young generation was saddled enough with fantastic debts, but now we've got, not just, we're going to have an enormous, large, bigger than 1 year's GDP federal debt, but we also have Social Security, which is about an unfunded liability, according to the most recent trustees report, of $53 trillion. That's in table 6F1 that just came out in April. That's about 2.5 years of GDP. Now we got Medicare, Medicaid. Taxes are low. Defense spending is high. We just don't have anything that works out in terms of an intertemporal across time budget constraint. So we have an enormous fiscal gap. It's probably in the order of magnitude of 180 to 200 trillion dollars right now, probably maybe 10 years of GDP. So our kids are not going to be able, you can't take that much from our kids to pay the people that own the bonds, that are waiting for the Social Security checks, waiting for their Medicare and Medicaid benefits. The old people, the young people just don't have enough wages to hand it over. So what we're going to possibly end up with is what they had in Ecuador, which is when things got that bad, the kids took off and left to Spain. About 500,000 of them from this tiny country picked up and left. And nothing saying that that can't happen in our country too. So I view what we're doing is kind of characteristic of a emerging country, not an advanced economy, just on so many dimensions. We look like an advanced economy in some ways, but in other ways, in terms of our politics and our how we're actually conducting policy, and just look at these deaths, we look like we're looking like Brazil.
Well, I think for a lot of financial advisors, they have to sit down with clients and estimate returns on portfolios in order to meet future goals. And both of you are a bit pessimistic, Lawrence a little bit more, about what real returns are going to look like in the future. I was just checking TIPS rates this morning, and 5-year TIPS are negative 0.48%. So the market thinks that a fair return, real after inflation return on a bond investment, a safe bond investment, is negative 0.48% per year. And there's some disagreement about how high the equity risk premium is going to be in the future. What should financial advisors be using as a real after inflation portfolio return these days?
Let me first comment with this. A big mistake that so many people make is they think about expected returns in a deterministic way. It's let's say PEs are 20, so you invert that, you get an earnings yield of 5%, and so you think future real returns would be 5%. Or if you took the CAPE 10, you'd get about 3% or so for a real expected return. And then they run with that. The only right way to think about expected returns is to think about a potential very wide dispersion of possible outcomes. So we think expected US returns today are probably in maybe 4% kind of range real, add 1 or 2% for inflation. International would be maybe 2% or so higher given valuations, and emerging might be roughly 2% higher than that. So that would be your mean, but you really have to think of that wide dispersion. If you look at the historical evidence, you need about, I think it's like 8% on either side of that to encompass all the outcomes that happened over the next 10 years. So if you start out with 4, you have to go all the way to -4, or you might get 12. I just don't see how you get the high number on the right side to be much better than expected, certainly with US, because valuations, I don't know how much higher they could go. But that would be my expectation for US stocks, would be something in the area of 3 to 4. Add a couple of percent for developed non-US with valuations lower, and emerging again somewhat higher because again of lower valuations.
Lawrence.
Well, I guess I would say if I'm a financial advisor talking to a client in this context, I'd say things look a whole lot riskier, and even if you're not trying to time the market for return, which nobody should try and do because they don't know, they can't read tea leaves, you should be timing it for risk. And if it's riskier, even though maybe whether or not the VIX says it today or not, we have a sense of all these unknowns that we've already been talking about. Will restaurants be able to be open in 6 months? Will we have inflation? Will we have deflation? Things are much riskier, uncertain. So that would lead people to naturally want to reduce their exposure. Also, their labor income is less certain. So that makes you want to even more doubly be less exposed in the market. So people should be reducing their equity positions, and we've seen that happening, I think, for most people. So if I were an advisor, I'd say, let's get you pretty much, not maybe 100%, but in large part out of the stock market, unless there's something that I think is kind of somewhat unrelated to these risks that is a pretty good bet. Maybe it's Dunkin' Donuts, that might come back. Even the local Dunkin' Donuts is closed. I don't know when that's going to open. But then you have to ask, then I would say, look, there's other things we can do. Let's make sure you're maximizing your lifetime Social Security benefits. Let's make sure if you're 62 and you just got laid off, that we change your plan so that you think about retiring later, work longer, but also if you need money in the short run, we have you take money out of your retirement account rather than your Social Security, because the retirement account return is risky, and the Social Security return is perfectly safe. The waiting to 70 gives you a huge return in terms of lifetime benefits. Let's think about taking your retirement account money and you withdrawing it now that your tax rate is low, withdrawing some of it or a lot of it to pay off your mortgage, because the mortgage refinance rates have not come down that much, because people, the banks are not sure whether people are going to lose their jobs and be able to repay the refinance. So they haven't come down. So if you're in like a 3.5 or 3.75% mortgage, and the rate now on a long-term treasury for 30-year treasury and a 30-year nominal treasury bond is 1.3%, and we're talking about over 2.5 roughly maybe basis points return that you can get for sure just by arbitrage, just by withdrawing your retirement account money. And if it's best would be to take Roth money out, because that's not taxable, but even taking taxable money out may be worthwhile. I wrote a paper that an article for Forbes. It's on my website at Kotlikoff.net about under columns. It's about cashing out your 401k to pay off your mortgage. It got about 500,000 hits. It shows that a typical middle-class household in this situation could potentially make $100,000 by just engaging in this perfectly safe transaction. Downsizing your house is another idea. Moving to a house that's less expensive. My wife and I are looking at this situation, and I have a small, I have a personal financial planning software company, so I have to make sure it's in good shape going forward. I've got 10 employees, so I want to make sure I'm not personally exposed, that I have the funds in case I need to lend money to the company if it loses sales. So we started looking around. We found out that Providence, the price of housing for the same type of quality housing is 1/4 as expensive, and it's only an extra, it's a 50-minute commute, 60-minute commute for me. So we just bought a house in Providence in the middle of this whole thing. We're moving in a month, and that's going to save us probably $300,000 or $400,000 in lifetime housing costs when you take into account the difference in the mortgage, not having a mortgage at a pretty high rate, not having to pay such high property taxes, insurance will be lower. So these are the kinds of things that I would be also, you maybe having somebody think about moving to a state where there's no income tax at this point. So there are things like this that you can steer your clients toward that can offset and do it safely their losses from losing their job or temporarily losing their job, or also having lost maybe money in the market. So I would make sure that you've optimized to the extent possible in these different dimensions, and then basically hold tight and see where things end up by staying cash pretty much on the financial side for a while.
Lawrence, you just scared the heck out of everybody when you talked about the federal budget. And if you have a client who comes in and says, I'm not going to delay Social Security because the government is going to go out of business, look at what they're doing right now, it's so fiscally irresponsible, what would you say in response?
Well, I would say that people that are close to retirement age, let's say within 5 years, they're not likely to see their benefits cut. Well, if they're rich, it's possible that the benefits for highly for rich people would be priced rather than waged. Well, maybe the CPI indexing will be reduced into the future. So there could be some benefit cuts, but if you take your benefit early, you're going to still face those benefit cuts. That's compared to if you take your benefit late. So I've looked at what happens, for example, if there's a significant increase in taxes or a significant reduction in benefits. out 10 years or so from now, does it really change your optimal planning with respect to taking Social Security at 70, which is probably the right thing to do for maybe 85% of the households? And it turns out it just doesn't, the gain from waiting is smaller, but there's still a significant gain. So this is where using sophisticated, very sophisticated, accurate software can help, because the answer might be different for one person versus another. And you might want to assume both a tax increase, including Social Security benefit taxes go up. And of course, again, that wouldn't necessarily affect your decision about waiting, but you could maybe, if you're richer, assume a bigger benefit cut, and that might influence whether or not you want to take your benefit earlier. But I think in general, it's still a smart strategy to be waiting. I can't think of a better deal out there than delaying your Social Security benefits, unless there's some other beneficiaries in your family whose benefits, like a dependent child and a spouse whose benefits depend on you're actually taking your benefits. To get them going, you have to take your benefits. That would be an argument for going early. But for most people, you want to be patient there.
Larry, what are your thoughts on Social Security?
Yeah, well, first of all, Social Security is not bankrupt. It's not going to zero like a lot of you hear from young people. But the estimates are right now, it's only going to fund, I think, about 78% or something like that at about 13 or 14 years out. So that's a real problem. And it tells me almost certainly whatever party is in power, we're likely to see significant increases in taxes to keep the benefits at a higher level. As Lawrence indicated, you could see higher taxes or even reduction in the benefits to some degree for people who are wealthy, might be means tested. That's possible. I think almost certainly you're going to see a dramatic increase in the wages that are taxed, because otherwise we will end up looking not like Italy, but like Argentina, which would be a far worse situation. But I think those things are almost certainly going to happen, just like they happened once before, and we took action. I think it was in the 80s to try to resolve some of that issue. So my advice is exactly the same as Lawrence's. You almost certainly, in most cases, the best thing to do is delay. It's the safest, highest risk-free rate of return you can get. You're buying very cheap longevity insurance, but you have to do the math and use good software. So for example, I would have thought for me, it made sense. I'll be 70 in 18 months or so. I was going to wait, but when I ran the numbers, it was better for my wife, who's 66, to apply for hers. And I went and got her spousal benefits, and a year from now, we'll swap. I'll file, and she'll take my spousal benefits, and then she'll get hers, fully. So you need good, sophisticated software, as Lawrence said, to help there. One other comment I just want to mention, I should have mentioned earlier. When you think about expected returns, that's why, to me, the only right way to think about this and plan is you have to use a Monte Carlo simulator to look at the various outcomes and what equity allocations and withdrawal rates are the most likely to allow you to achieve your goal. And then you have to decide how much risk you could take. So a good example is someone like Lawrence, who had the ability to move to a cheaper cost of living location, could say, well, I could cut expenses. I could live with a 20% chance of failure because I could save, $20,000 a year by moving, or whatever the numbers are. But take maybe the widow who's renting an apartment and doesn't even own a car, and there's nothing she could cut. Now you want to see 99% odds of success because failure is unthinkable. So you really need to run the Monte Carlos and make sure the advisor is challenging the client to say, all right, you say you could do these things like move to a zero cost state, downsize your home, but are you really willing to move away from the grandkids? I mean, you have to have a plan B that you are willing and able to execute.
Yeah, let me just jump in on this. So I agree. Definitely looking at the whole distribution of outcomes is really important. And my software company, we have a program called Maxify Planner, where what we're looking at is the Monte Carlo simulations on your living standard, not on the probability of making some preset plan based on some target. Rather, what economics says is that if the market drops and your assets are lower, you should drop your spending. And if things turn out and they do well next year, you should raise your spending. You should be adjusting your spending as you go along in light of what's happened. And so that's what our software does. It lets you see the variability of your living standard, the sequence of return risk, but also takes all these numbers that you get from 500 different trajectories based on a given investment strategy and says, gee, how does this translate into lifetime happiness? And economics has this notion of expected lifetime happiness, average lifetime happiness from consumption. And so when you run these simulations of your living standard, we then plug those living standard trajectories into a lifetime happiness measure. That's a very standard one in economics. Take the average of 500 realized lifetime happinesses, and that's your what's called expected or average lifetime utility from investing this way and spending this aggressively versus doing it this way and spending maybe less aggressively or more aggressively. And then what Larry's referencing, which is the risk aversion, your risk tolerance, that comes into the comparison. Is this better than this, and by how much? So there is now a scientific way, or a way that connects to economic science for people to give advice to clients. We've been waiting for, we've had about 11 Nobel Prizes in finance have been awarded. Almost everybody who's gotten a Nobel Prize in finance has worked on the expected utility maximization. And we finally now have a tool which actually does it, and where you can actually come up with, 80% stocks versus and 20% bonds versus 50-50. Well, how do they really compare? I can't look at all these trajectories and figure it out, but I can look at this number versus that number and say, okay, if I'm this risk averse, then this one beats that one. If I'm this risk averse, it's the other way around. Then you can kind of more systematically get to an answer in accord with what economics says to do.
We've talked about the fact that in order not to be Argentina, we're going to have to start taxing people more in the future. But everybody wants the government to tax somebody else. So if you're a financial advisor, what kind of strategies can you mention to a client about avoiding inevitable increases in marginal tax rates? And I'm talking specifically about things like using Roth, the idea that capital gains tax rates are probably going to have to go up in the future. What impact is dividend tax increases going to have on income stocks? What kind of risks are associated with a rise in taxation in the future, and how can a financial advisor handle that?
Yeah, well, I'll just touch on one that you didn't mention. To me is the easiest, simplest one that's at risk, which is currently, if you're wealthy, you can exempt about $23 million if you're with a spouse, and no one knows what will happen come January, but I think certainly it would be foolish not to take the risk that that number could not be cut dramatically, even down to 1 or 2 million. So the number one thing I would tell people is that they ought to be doing estate planning, moving as much of their assets as possible to irrevocable trusts now, to avoid the possible risk, if not high likelihood, of that occurring. Right now, this is a good time, for example, where if you had stocks in your IRA account, it's gone down in value. And you may have losses that you could have deducted. Your income might be low because unemployed. What a great time to be doing conversions to Roths. with income tax rates now quite likely lower than they'll be by maybe even wide margins in the future. Even for the wealthier people today, or higher income, they could be facing significantly higher marginal rates as well. So it certainly is at least worth looking at those things today.
Yeah, I agree. Roth conversions, this might be exactly the right time to do a Roth conversion. This might be the time to move to the Virgin Islands, where I think there's no tax, federal income tax, or Puerto Rico. Seriously, that's not a crazy idea. If you can work remotely, you can work just as well from the Virgin Islands, and avoid all federal income taxes entirely. But I agree with Larry. This is the time to be making gifts to kids to avoid estate taxes. And I don't know too much about irrevocable trust, whether they would get hit by future tax hikes, but perhaps not. I guess this is a tax exempt mechanism, but gifts certainly would be called for right now, I think.
Now, you both mentioned the risk of munis. What can you tell clients, especially because it seems like munis are very vulnerable on a number of fronts, that municipalities are going to be running short on revenue this year. There's a lot of promised pension debt, and even things like the deductibility of interest from federal taxation is not set in stone. How risky are munis these days?
Well, let me just state that we've been building our own individual bond portfolios for 25 years. And because our belief is that fixed income is sole purpose is not to generate income, but to dampen the risk of your overall portfolio. The risk premiums just are not worth it, we think, because the risks show up at the wrong time. So you get that correlation. So we have always limited municipal bonds to AAA, AA, and they must also be either essential service revenue bonds or general obligation. And even then, there are about 8 states we won't buy any bonds from because the state is in such bad shape in terms of their adjusted net liabilities that you might have a school district which looks good, but they depend on the state for some of the revenue and support. So there are a lot of states and a lot of municipal bonds we wouldn't touch. But there is a whole bunch of them that are in very good shape still. Now, a lot of them are going to face problems because their revenues are way down, as you pointed out. Their income taxes are likely to be a lot lower, and their value of their pensions have gone down, and most of them have too high assumptions on the rates they expect. I mean, I don't know how you project 7 or 8% returns when for at least U.S. equities, we're talking maybe 6, and for bonds 1, I don't know how you get a projected of 7. So they're going to be forced, I think, to make more contributions, stressing their budgets. So you really need to stick with the highest quality here. Do not stretch for yield with municipals. In my opinion, that would be a big mistake.
Yeah.
Yeah,
I want to just reemphasize what Larry's saying about a lot of these state and localities, local governments have been promising pension benefits. And then when they look at the unfunded liability, they say, well, we're going to earn 7-8% real on our investments. And we're going to just take those, that whole path of nominal obligations to pay pension benefits and discount it at this very high rate. And then it becomes a small number that has to be funded. And then we don't put enough money into the pension fund to cover that liability. So when you discount at the proper rate, I mean, we're talking about a safe liability, a liability that you actually have to make unless you go bankrupt. That should be discounted at the TIPS rate, the TIPS term structure, which, as you said, Michael's negative in the short run and probably 0 in the long run. So we're talking about just crazy valuations of unfunded liability, crazy small compared to what the truth is valuation. So I would be very careful with any investing in any state government where I hadn't done a real full, what we call fiscal gap analysis with proper assumptions to see what is the true outlays going forward, what are the true receipts, and let's risk adjust everything and see what this really looks like. And I would stay away. It's just too dangerous. And we got a administration that's very adverse to helping out the states because most of the help would go to the blue states. So this is not a good time to be in munis.
So even though nobody's getting much return on anything, reaching for yield is probably not the best idea either in munis or in corporate bonds.
Yeah, I would agree with that. Again, because there's always the risk of the left tail showing up. We could look like Japan because of all the debt Larry's talking about. It could be a second, third waves of the virus create bigger risks than the market is anticipating now. And if we get that, then you've got serious problems for the stock market at very high valuations. And then all these corporate bonds become at risk, REITs become at risk, and the municipal bonds become riskier. This is not a time to be taking risk on the bond side. Now, if you want to sell equities and take a little bit more risk in bonds, that's still reducing risk somewhat because there are, even a single A muni is a lot safer than an equity. So you might go there, but if you're stretching for yield to take credit risk, then you should come from the equity portion of your portfolio, not from the safe bonds.
Yeah.
Now, I can't let you go, Larry, without at least some discussion of equities and the pounding that value stocks have taken over the last decade, and it continues to happen. Do you see any sort of a reversal for value stocks in the coming years?
Well, let's just, I've written about 8 papers on this now. One was just published on Seeking Alpha this morning. Let me just say this. There are lots of stories around the value underperformance. It's been so bad in the last 3 years or so since 17 that it's underperformed all the way back like 12, 13 years. But all of the underperformance, which is, by the way, the biggest drawdown in history from January of 17 through March 23rd of this year, was like 50% drawdown for value relative to growth. Much worse than anything we had ever seen. There are lots of stories, FANG stocks and interest rates and stuff. None of them hold up to any scrutiny. There are some good papers written. I've summarized them in articles. The only reason that value literally is underperformed has nothing to do with fundamentals, because value stocks continue to have lower ROAs than growth stocks, about the same as they've had historically. I think it's like, say, 5% lower ROAs and maybe 11% lower ROEs. Almost no difference. 100% or more of the underperformance of value is an exact repeat of what happened in 98 and 99 and early 2000. The PE ratio spreads went wild. So think of it this way. Historically, roughly, let's say, market's got a PE of 15. We're going to make the math easy. Value 10 and growth is 20. Well, let's say the PE for the market stayed unchanged at 15 and value at 10, but growth went to 30 and the value premium lost 50%, which is what happened. That's basically what's happened. Now, we did get economic risk show up. This is when value companies get into bigger trouble. They have more irreversible capital, more erratic earnings. So now they're getting hit. If we continue to have serious economic problems as drags out, I wouldn't expect value to do well. If we get a faster recovery or even a stable situation, because of where the valuations are, I would expect value to far outperform. but the risks are still there. Cheap can get a lot cheaper, and the risks can show up. It's not a free lunch. Never was.
Well, it'll definitely be interesting to see how things play out over the next couple of years. I want to thank everyone for attending. This concludes our 4-part webcast series tackling COVID-19's impact from all angles. During this unprecedented crisis, I want to thank all of the thought leaders who've taken the time to help inform all of you over the last 2 months. Be safe, be well, and continue to be pillars of guidance for your clients and your communities. We'll talk again soon.